Welcome to another real estate industry update. I'm your host, Daniel Riconti, here with Kyle Paxton. Today's episode, we're going to talk about it's the end of the tax year coming up for 2025, and so we're going to talk about a little bit of end of year tax planning. Just a lot has happened this year with the one big beautiful bill, but there's still some of the common things that we always need to be doing at the end of the year. So, Kyle, give us an idea of tax planning from a big picture. What's different and what's different important for 2025?
Let's get into it, shall we? I don't know about you, Daniel, but if I have to say one big beautiful bill one more time, I don't know if I can. It's been all year, over and over and over, so still gonna chuckle every time. But no, O E
BA
B
just
B
doesn't
B A P
never
P
ring,
B B A.
it doesn't ring the same.
At a high level, like I just want to start from airplane level here. This is a really good time to take a pause and look at your tax picture again, especially if you haven't done it in a couple years. A lot of changes on the tax front. We talked about the one big beautiful bill, and we're coming up with here in the last month or so of the year. There's still time to implement tax planning strategies, and it's a lot easier to mitigate tax liability on December 1st, December 15th than it is on April 15th. Looking backwards, so that to the extent we can get these things in motion before year end, that's great. So if you haven't checked in with your tax advisor, now is a wonderful time to do. Getting into your question, what's different and what's important. We're in a transition period. We had the Tax Cuts and Jobs Act in 2018 that has sustained us for a handful of years here, and now some of those provisions have been extended. The one big beautiful bill has reframed a lot of those tax strategies we have been using in the last several years. So really, it's a lot's changed, and there's a lot of opportunity to greatly mitigate your tax liability. So in looking at just what that means for real estate, it's really a lot of our real estate tax planning strategy is around time value of money and different strategies that help you defer tax liability into the future and potentially create this snowball effect here. So what the one big beautiful bill really has done for us has empowered us to continue that strategy and implemented a lot of the strategies we use here. And I think again, it's a really good time to look at the timing of those deductions, and some deals have slowed down and things. So really looking at, while we're in the hold pattern here, how do we optimize our tax picture? Daniel, can you speak a little bit about the timing and strategies we can use in terms of really understanding where we're at now, what that tax liability is before year end to start talking about these things?
Yeah, what we need to realize is that if we're going to do anything, we need to do it before the tax year.
Yeah.
Your options are very limited once December 31st is
Yep.
passed. Okay. Not saying there's no options, it's just very limited. Okay. So we still got about a month or so left in the year. And so we still have some time. But in the real estate world, you can't buy in real estate like you can stock. At least not yet. Maybe in the
Right.
future. So let's strategies get limited as the year ends, but you still have time here. All right. We talked a little bit about the one big beautiful bill. We're not going to go over everything because we've had other videos on that. But the big one is the 100% bonus depreciation. Okay. This is introducing great cost segregations, capital improvements, things like that. These that can produce basically 100% bonus depreciation and give you a great write off at the end of the year. All right. But for these things to happen, this needs to be in service before the end of the year. All right. So if I'm buying real estate, I'm like, oh, I'm going to buy something here in the end of December. It still needs to be in service. So you need to buy something turnkey that's already in service, something that you don't need to improve to get it into service. So think about that. Just big picture here is all right, if I'm buying real estate, I'm going to try and use this cost segregation thing. Make sure that I'm having enough time to buy the property and truly put it in service. I see a lot of times where people buy the property in December, they don't necessarily have to have a tenant in it. That's, I think, a big misconception with a lot of
Right.
people. Is it just needs to be able to be rented and you're trying to rent it. It usually takes a month or two to get a tenant in there. That's completely fine. So when I'm working with my clients, I'm like, all right, you bought it. Is the tenant able to live in there? Are you advertising it? Okay. Think big picture, whether is this really in service? Okay. If I'm having to put a whole new roof on it and do all these other things, I got to get a roofer out there, whatever. Now it's going to have a much more difficult time for me to say this was in service before the end of the year. It's probably not going to be in service until next year because if anyone's trying to put a roof on their house, especially here in the state of Florida, it takes a couple months. Just Thankfully, it's come back down since the hurricanes. But for a while there, you couldn't get anyone for 6 months to
Right.
even replace your roof. So it takes time. But if that's simple stuff like repairs and maintenance, like replacing the carpet, things like that, those are still items that you have a little bit of wiggle room where you can say it's still livable. I'm just doing a little bit of minor improvement to get it back into shape, but it's still in service and I'm advertising it. I'm trying to get a tenant in it immediately. So, just big picture here is just knowing, hey, if I want to take advantage of stuff, know the rules. That's, I think, the biggest thing is know the rules of when I can get this 100% bonus depreciation. It's got to be in service before the end of the year. And with real estate, nothing is instant. So you need to be planning for that. Okay.
I've had a lot of conversations recently about the timing, and that, to your point, that's something that gets lost sometimes, and especially around the one big beautiful bill where every provision in that thing has a different effective date. Dates are very important right now. So that gets back to the communication and understanding, really getting a grasp on where you're at currently, what may come through before year end or right at year end, and being able to, if you can, tweak the timing of those things goes a long way. And it's as simple as, if you're a cash basis taxpayer, which a lot of our real estate clients are, what deductions can you accelerate into if you're going to do a repair either in December or in January 2026? If you have control of the timing, push that thing up into the current year here and be able to take the deduction. So the same concept applies, like you said, for putting a new building in service, whether you're acquiring it or building it, you're developing it yourself. It becomes the, can we meet that placed in service status before year end so we can perform a cost segregation, accelerate the depreciation, and be able to take that deduction this year. So those are really good points, and something that definitely does get lost sometimes is just the timing on executing quote unquote simple things and how that impacts your tax picture. Those are all
Yep.
really good points. So as Daniel said, we've talked in other videos. I encourage you to browse our channel around depreciation and cost segregations. That's the big ticket item here in the real estate space under the one big beautiful bill. And it gets back to, we're playing with the time value of money. We're accelerating deductions and really trying to free up cash for you now that you can do bigger and better things with than pay tax. And that's the strategy that I'm looking at with all my clients right now. It's involved in every conversation I'm having with my real estate clients is, how can we implement cost segregations? It doesn't make sense for you. And then it's identifying what is the right property for that. And a lot of instances, it's a property that was acquired and placed in service after January 19th, 2025, because it qualifies for 100% bonus depreciation again. And that, again, that's part of just about every conversation I'm having right now. If you own real estate, you should be having that conversation and how it impacts you, the rest of your tax picture. I'll pause. Daniel,
Yeah.
do you have anything to add there before I dive into
You made a good comment about most of our clients or just real estate investors in general are going to be cash basis. By being cash basis, understanding what does cash basis mean? That usually means that we are going to pick up the income and deduct the expenses in the year it's paid or received. Okay. Where if you're on accrual basis, it means you pick it up when it's earned, even if it's not paid. That's usually AR, AP. So if I have accounts receivable, someone owes me money, but they haven't paid me yet. Okay. Since we're on cash basis, this is always a good idea to be like, all right, at the end of the year, kind of do a little projection. What am I going to owe? Is my rental property making money this year? Should I start paying all those property taxes in December? Should I hold off into January? Should I be doing something like that? Should I be front loading my expenses? This is a good time to just understand what your true tax situation is and understand when that expense is. And then you want to look at, we mentioned already 100% bonus, but you really want to understand what's your capital improvements. What is that going to look like for you? The de minimis rule is 2,500. That means that if I put any kind of capital improvement and it's going to be under $2,500, I'm allowed to expense it. If it's over $2,500, now I have to consider if I need to capitalize it and depreciate it. All right. 100% bonus depreciation only qualifies for certain improvements. All right. 5, 7, 15-year life kind of improvements. Things that are your standard improvements like 27 and a half or 39 if it's commercial, those still are not eligible for bonus depreciation. So you need to understand, if I'm putting a new roof on my house, okay, on my rental property, all right, probably not going to get bonus depreciation on that. All right. Am I doing a significant renovations where I'm putting $50,000, $100,000 into it? Okay, maybe I'm not going to get bonus, or only a few things are going to be bonus eligible. A lot of that stuff, Even though I put a significant amount of money into the property, got to realize that I'm not getting that full deduction the year that I went out there and I actually put in the improvements. I'm going to get depreciated over amount of time. So do understand your rules and the timing of that. We talked a little bit about cost segregations. You actually don't need to do the study in the same year you're getting it. So you can wait until after the end of the year if you want to do a cost segregation study. But this is a good time to start looking at, is this something, is it worth it? Okay. Does it make sense? Do know that people that do cost segregation studies, they get a little packed up in the middle of tax season. Don't wait too long. You want to make sure you're on the list, getting it done more in the early of the years, or if you're okay with extending your return and getting it done afterwards. But if you try to get a cost segregation study in March and April, it's going to be a little bit more difficult. Okay. But do know that you don't have to get it done in the end of the year. 1031 exchanges, something that we don't always think about, but there's actually end of year tax planning with this because it can go across years. I don't have to buy a property or sell a property and buy a property within the same tax year to get the benefit. I have 180 days, okay, to sell my property and buy a new property. If I sell one right now, 180 days is going to be in next year. It's going to be in 2026. That's okay. Okay, does create a little bit of a complication because you got to report the like kind exchange and everything in 2025. Kyle and I know this because, when you deal with the compliance side, the headaches and everything, but it's still a good
I might
option to
grumble a little
consider.
bit, but it's a great strategy.
It's still a great strategy. Like kind exchanges are, and even if it fails, okay, which happens, like I find something, it fails. Guess what? I can still treat it like an installment sale, and it's not taxable in 2025. It's taxable in 2026 when I actually receive the cash back. Okay, so there is some strategy around that. Can exchanges are still great end of year tax things to implement because when we're doing projections for our clients, we're like, here's what the projected taxable if you don't do a like kind exchange, and they're like, I don't know if I can find a new property, but let's go out there, let's do the 1031 exchange, and let's see if it happens, and even if it fails, at least defer it for one more year.
Yeah,
Okay.
that's a strategy that's overlooked quite a bit. And it goes back to just transaction planning and making sure you have the right people in the room to do that. Because a 1 year deferral can be a big deal. And then in talking about the cost segregations, there's potential where deferring 1 year frees up more strategies to where you can defer some of that or defer that gain potentially even further in ways. And I definitely think that's an overlooked strategy and something that's important to consider. But the key comes back to it 1031 exchanges all the time. You can't harp on it enough. You cannot touch the cash. If the cash becomes available to you and is not held with a qualified intermediary, that potential installment treatment is blown and you recognize the gain in the year of the sale there. So it's a very important thing to keep in mind. But 1031s are alive and well. They aren't going anywhere, and we'll continue to see more of those as a significant part in our tax planning.
Then let's harp a little bit on the real estate professional
Yeah.
status. So most of our clients, if you're dealing with real estate, you know about this. You talk about it, you want to make sure you're getting it. Because all the real estate professional status does is says, hey, to the IRS, I'm a real estate professional. And so my rental losses can now offset my non rental, basically, income. Okay. Where if you don't have this real estate professional status, it's called the passive activity loss rules. All right. And it just basically means that those losses cannot offset active income from real estate. All right. Most normal investors like that, if we start, let's say me and Kyle for an instance, okay? We're CPAs. We're not allowed to be real estate professional status. We'll go into the reasons why. So if we invest in real estate on this side, doesn't mean that it's not still a great investment. It just means we don't get that extra benefit of taking those losses, especially when we're dealing with like cost segregation sales. So those losses are limited. So you really want to make sure by the end of the year here, am I meeting real estate professional status? If there's any concerns, you need to know the rules of why. So let's quickly go over what the rules are for real estate professional status. So the first one is more than half of your time needs to be in a real property trade or business. Okay. This is why Kyle and I cannot be real estate professional status
I
because
spend too much time accounting.
we are CPAs and
Yeah.
that is not a real property trader business. And half our time cannot be. So, just for an instance here, if you have a full time job, okay, a W 2 job, it's already really difficult for you to meet this basic. So this was really for people that are really in the real property trader business. This can be real estate agents. These can be operators of real estate. These can be construction owners. These can be flippers, developers, anything like that would be basically a real property trader business. Okay. The next one is 750 hours needs to be in real property trader business. Again, this doesn't mean it has to be rental properties. It just means I am a real estate agent. Okay, great. And I don't have any other job. Then more than half my time is in it. And I just need to put at least 750 hours in my real property trader business, which is easy because if you don't know this, about 2,080 hours is about a full time equivalent. Okay. So 750 means you're not even working half time.
Pretty low
Half the
bar.
time that pretty low bar.
Yeah.
Okay. You'd be surprised how many people are meeting that. And then the last one is you have to materially participate in each activity of your rental real estate. There's multiple ways to materially participate. The most common ones is that you put in at least 100 hours and no one puts in more hours than you. So these are people that are operating their own real estate properties. They're not using property management or anything like that because property management might put more hours in than you. Or the easier one is 500 safe hours. So if I put at least 500 hours into my rental properties, then I get it. The IRS allows us to group all rental real estate together. So that way I can meet that 500 hours rule easier if I have 10 rentals that are grouped together than one rental. So when I deal with this with some people who hear all the wonderful benefits of real estate, they're like, hey, I got a W 2. I'm going to buy this rental property. I'm going to put it in service before the end of the year and I'm going to get real estate professional status. And then I have to basically go, we need to read over the rules. You're going to have some difficulties here. Okay. There is a short term, okay, that we're not going to go into because it's a whole different thing. That does not determine the real estate professional status. The short term rental properties is a way to basically get around the real estate professional status. This is how some W 2 people are allowed to take cost segregations and these benefits, these deductions against their W 2 income. That's a whole separate video that we probably have done at some point. But for real estate professional status, it's really true to understand, am I meeting the hour requirements before the end of the year? Okay. So that I can truly get these deductions that I want and they're not going to get suspended on my return.
Daniel brought his A game today. That's another good point. I get that question all the time about the short-term rental loophole. That's an easy one on LinkedIn, Instagram, everywhere on how to mitigate tax liability. But if you're already reaching real estate professional status, you're getting a similar benefit is that what that loophole brings to the table. One other point I want to make on real estate professional status, and just to emphasize the point of year-end tax planning, is I see a lot of my clients are healthcare professionals, attorneys, things of that nature, engineers who either get burned out or sell their business or something like that mid-year. They take money from the sale of their business, they pivot into real estate. It is not, we talked about the 750-hour requirement, everything else. It's not that hard to reach real estate professional status. And if you have some sort of large income event in the year, and then you can turn around and meet real estate professional status because your facts and circumstances changed, you can go a long way in mitigating some tax with the options that real estate professional status brings to the table. Important component there. I do want to touch real quick as we wrap up here on just a couple other things that we can do before year end and things that you should be talking to your advisors about. One is just looking at retirement accounts. It's a good time depending on where you go with that. If you don't have retirement accounts set up yet, there's some options that have to be set up and funded in some way by year end. Some are tax deadlines. Anyway, we got a month to start those conversations. Potential charitable strategies. If maybe you don't have a charity lined up, but you have money that you want to set aside to do that, there's strategies that you would implement there before year end. And then one other thing that's not directly related to just 2025 tax mitigation, but right now when we're doing the tax planning, we see those ugly tax bills that we're expecting in some instances for 2025. It's a good time to do an entity structure check-in and say, hey, how are my entities set up? Obviously, there's a whole separate legal conversation we're not talking to here, but how are my businesses set up? And is there a way I can do it better January 1st, 2026 moving forward, where maybe I have an unpleasant surprise coming for 2025. I don't know if surprise is the right term because we're still ahead of the game a little bit and coming on that. But if I have a hearty tax bill for 2025, is there something I can be doing better that I would want to implement at January 1st, 2026 to operate better going forward? So those are more conversations I'm having with my clients right now and just making sure we're set up well for that switch as we approach.
I'm gonna add on here with Kyle here. We talk a lot about rental real estate, okay? But when you're talking about real estate in general, especially if you're a real estate professional, you're probably in a real property trader business. You're probably producing some form of what we call self-employment taxes.
Yep.
This is income that you're producing that is subject to self-employment taxes. So you really want to make sure that you have the correct entities. If you're going to have a really good year, is this in an LLC? Should we be making an S corp election? Okay. When do we need to make it by? Can we do a late filing election? Do we need to, if we're doing an S corp, do we need to pay a salary? What's that going to be at the end of the year? With our flippers, this is really tough for developers because they can make $0. So do we really always want to pay ourselves a salary if we're making no profit this year? And then we want to optimize it for 199A. That's the qualified business income deduction. All right. We want to max out that 20% deduction. So we want to make sure that we're paying ourselves wages to optimize it. So we're not losing out on any deduction here. These are just simple things to be doing. But if you don't do them before the end of the year, we're they have limited options to help you, if at all, at the end of the year. Kyle also mentioned retirement. Usually, contributions to retirement have to be in the year. So, if I'm a real estate agent, and let's just say I'm a high earning real estate agent that has an LLC, and I do the S Corp election because I'm all about saving my taxes on self employment, pretty normal stuff here. Should I consider opening up a solo 401k? Is there other ways that I can take these high profits I've had, put them into retirement accounts? What's the benefit of it? What is my projected tax rate? Because doing it at 37% is significantly more important than doing it at something like a 15% rate. So we're really want to playing with the numbers here and really optimizing you paying the littlest amount of taxes, all by doing a little bit of back end of year tax planning that optimizes your tax situation, which if you didn't, can cost you thousands of dollars at the end of the year.
Daniel, I want to make one more point before we wrap up, and it piggybacks off what you said. I could talk about self-employment tax all day, but that is the Trojan horse in all of this and planning for real estate professionals. In that real estate professional status and cost segregations and everything else we touch on is a great strategy for reducing income tax. But if you have this flipping activity or another ordinary income producing activity over here that is subject to self-employment tax, that 15.3% can hurt when you're anticipating being able to either wipe your income or significantly reduce your income with cost segregations and other strategies. So that gets back to our point where entity structure is so important in that to mitigate those surprises.
Yep. Last couple things I want to wrap up here before we end this call. Okay. Just a reminder, business returns are due March 15th. Personal returns are due April 15th. So make sure that you understand when your deadlines are. Thing matters a lot. Garbage in produces garbage out. I've said
Through
this all the
that,
time, right? If you do not have good bookkeeping, if you do not have good record keeping, there's only so much a CPA can do to help your tax situation. So you need to really understand here at the end of the year. Make sure we have good record keeping that we can provide to our CPA so it's accurate. Okay, not counting the fact that if it's wrong, you could potentially have an IRS problem. Okay, quarter estimated payments. Those are coming up on January 15th. So just keep that in mind that I have that there, a payment potentially owed if I'm going to owe quarterly payments. Okay. And this is way off in the future, but I'm reminding all my clients right now, opportunity zones. If you invested in one, that tax bill is coming up at the end of 2026. So we're coming up on about a year away from that. So if you have invested in an opportunity zone, that originally deferred gain is going to be due in 2026 tax bill. So get ready for it now so that's not a surprise. Thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to helping you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.